In the last 24 hours, the financial world has felt like it was caught in a sudden, unexpected earthquake. If you glanced at your portfolio this morning, or even just watched the news, you probably saw it. A sea of crimson red washed over the S500 heatmap, an unnerving digital bloodbath. Major indices plummeted, wiping billions of dollars off valuations in a blink of an eye. Futures for the ST500, the Dow, and the Nasdaq all registered significant, stomach-churning declines. Meanwhile, the old reliables, the safe haven assets, are having a field day. Gold, that ancient store of wealth, is surging. Our go-to indicator for investor anxiety, the VIX index, affectionately known as the fear gauge, is not just ticking up, it is spiking by over 25%. That's a quarter more fear injected into the global bloodstream in a single day. What's going on? It isn't a surprise inflation report no one saw coming, nor a sudden hawkish rate hike that caught even the most seasoned economists off guard. This time, the culprit isn't some abstract economic data point or a central bank's cryptic pronouncement. The tremor shaking the markets comes from an all too familiar, yet stubbornly unpredictable force from the past. It's a figure who, even out of the direct political spotlight, seems to cast a long shadow over 2026. Donald Trump. Are we witnessing the initial shockwaves of a truly global geopolitical earthquake? Or is this merely the opening gambit in a high-stakes, strategic chess game where your investments are very much on the board? Just a few short weeks ago, as we barely had time to put away our holiday decorations and toast to the promise of 2026, there was a palpable sense of renewed optimism in the air. It felt like the global economy, after years of navigating pandemic aftershocks, inflation jitters, and geopolitical hotspots, was finally finding its stride. We had seen some stabilization, a degree of predictability returning to central bank policies, and a general cautious consensus among analysts. The path forward for growth, particularly driven by technological innovation, looked clearer. Many were genuinely excited about the upcoming earnings season, anticipating robust reports that would confirm a healthy underlying corporate sector. We were eager to see how the next wave of AI advancements was translating into real-world profits and productivity gains. The market landscape felt like a spring morning after a long, unpredictable winter, fresh, full of potential, poised for growth, ready to bloom. But as quickly as a summer storm rolls in from nowhere, that hard-won calm has been shattered. Collective optimism was abruptly swept away by a sudden squall. What began as a week poised for crucial earnings reports, for those granular data points on corporate health, consumer spending, and manufacturing output that typically move markets, has instead been utterly dominated by something far less quantifiable, far more volatile. This is a resurgence of intense geopolitical posturing and an almost overwhelming cloud of policy uncertainty. It's as if the world's financial weather vane suddenly spun wildly off course, pointing not to economic fundamentals, but to the unpredictable winds of political ambition. Our market analysts, with their fingers constantly on the pulse of every flicker and tremor in the global financial system, are tracking sharp drops across the titans of our modern economy. These are the so-called Magnificent Seven: Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla. These weren't just minor blips. These were significant, multi-percent declines across the board for companies whose market capitalization alone could rival entire national economies. When these technological behemoths, these engines of innovation and growth, sneeze, the entire market catches a cold. In this particular instance, it's more akin to a systemic pneumonia. This isn't simply a minor correction or a healthy profit-taking exercise. No, this reflects a much deeper, more pervasive concern that has taken root in the collective psyche of global investors. It's the reemergence of a very specific, aggressive, and frankly, historically disruptive America First approach to global trade and diplomacy. For those who lived through the previous administration, that phrase, America First, carries a very particular, almost visceral weight. It's not just a catchy slogan, it's a deeply ingrained policy framework that prioritizes domestic interests. This often comes with a stark, zero-sum game mentality, frequently at the perceived expense of long-standing international cooperation, established alliances, and the intricate web of multilateral trade agreements that have defined global commerce for decades. It's a worldview that tends to view trade as a weapon, alliances as transactional, and international norms as negotiable. The market, as we are seeing today with alarming clarity, absolutely loathes uncertainty. This is especially true for the brand of uncertainty that can upend established supply chains, ignite multi-front trade wars, and trigger a dizzying array of unpredictable retaliatory measures from nations accustomed to a different set of rules. This isn't your garden variety economic slowdown, born from rising interest rates or a dip in consumer confidence. This is something far more nebulous, far less predictable. Economic risks, while challenging, often operate within established models. They are driven by data points we can analyze, trends we can project, and policies we can anticipate. But political risk, especially of this assertive and personalized variety, operates on a different frequency entirely. It's driven by rhetoric that can shift on a dime, by personalities that defy conventional diplomatic logic, and by a willingness to challenge the very foundations of global consensus. This isn't just about abstract market numbers flickering red on a screen. This is about a return to a specific, highly potent brand of political risk that has historically created significant, sometimes violent, volatility across nearly every asset class. It's a risk that fundamentally challenges the very assumptions upon which international business strategies and long-term investment decisions are typically made. It forces multinational corporations to reevaluate their global footprint, their supply chains, their manufacturing bases, and even their political relationships with host countries. The domino effect is palpable. A threat to one nation triggers anxieties in another. A tariff proposed here generates whispers of retaliation there. Suddenly, the carefully constructed edifice of global trade begins to creak under the strain. It leaves investors from the smallest retail trader trying to secure their retirement to the largest institutional fund managing trillions, asking urgent questions. How are we supposed to navigate this new, tumultuous season of uncertainty? How do you accurately price in the truly unpredictable? How do you effectively hedge against a stream of rhetoric that can, and often does, morph into consequential policy almost overnight? This isn't just a bump in the road. It feels like the very foundational pavement of the global economy has been torn up and rerouted by an unseen yet very deliberate hand. This leaves us all to wonder what lies around the next political corner. It demands a new playbook, a reevaluation of what constitutes risk and opportunity in a world where geopolitics has once again taken center stage, threatening to overshadow even the most powerful economic trends. To navigate this new season of uncertainty, we must understand the mechanism at play. Let's break down the playbook we are witnessing. We are seeing a familiar, almost theatrical pattern of aggressive pronouncements emanating from Donald Trump. These are clearly designed to assert dominance, test boundaries, and ultimately gain leverage. This isn't simply abstract rhetoric, mere words swirling in the political ether. It's a carefully orchestrated campaign that is demonstrably impacting everything from the nuanced dance of international relations to the bedrock principles of domestic financial policy. It's a strategy rooted in shock and awe, aimed at keeping adversaries, allies, and even domestic institutions off balance, constantly reacting to the latest declaration. On the global stage, the audacious demands have been particularly jarring. Consider, for instance, his renewed insistence on the United States' acquisition of Greenland. This isn't just a quirky historical footnote resurfacing. It's a bold, almost audacious claim on a strategically vital territory, rich in potential resources, sitting at a critical geopolitical crossroads. To Denmark, the current sovereign power, it's not just an insult. It's a direct challenge to national sovereignty designed to extract concessions or, at the very least, create immense diplomatic pressure. This kind of demand, non-negotiable and seemingly out of the blue, throws a wrench into established international protocols. It puts allied nations on the defensive and creates an environment of diplomatic unease. Then there are the thinly veiled and sometimes overtly stated threats against key NATO allies like the United Kingdom, France, and Germany. The rationale, often articulated in the past, revolves around perceived insufficiencies in defense spending and burden sharing. But these aren't just polite diplomatic nudges. They are pronouncements that fundamentally question the very premise of collective security, undermining decades of painstakingly built alliances. When the leader of the most powerful member nation openly questions the value of the alliance, it injects a potent dose of instability. This forces these nations to consider alternative defense strategies and potentially fractures a united front against global threats. Furthermore, controversial engagements in volatile regions like Venezuela and Iran hint at a potential return to aggressive, quote, maximum pressure campaigns. These historically have led to increased regional instability, heightened tensions, and, critically for investors, significant jitters in global oil markets, impacting everything from energy prices to corporate earnings. Domestically, the impact is no less profound. We have witnessed his open pressure on the Federal Reserve, the independent central bank of the United States. His advocacy for forced rate cuts isn't just an opinion, it's a direct challenge to the Fed's independence, a principle meticulously guarded for its role in maintaining economic stability. It also insulates monetary policy from short-term political whims. Imagine the pilot of a transatlantic flight being constantly yelled at by a passenger to change course, irrespective of weather patterns or flight plans. That's essentially what interfering with the Fed's independence risks. It could lead to policy decisions driven by political expediency rather than sound economic fundamentals, potentially sparking inflation, creating boom-bust cycles, and ultimately eroding global confidence in the stability of the U.S. financial system. Such interference, by undermining the credibility of independent institutions, risks long-term economic instability that far outweighs any perceived short-term political gain. Even more specifically, his targeting of financial institutions with proposals like a 10% cap on credit card interest rates, while ostensibly framed as benefiting the American public, raises significant red flags for market stability and economic equity. On the surface, it sounds like a consumer-friendly move, promising relief to millions struggling with high-interest debt. However, the economic reality is often more complex, even paradoxical. Banks do not simply absorb such a cap, they react. For instance, credit card caps could, ironically, lead to a drastic reduction in credit access for subprime borrowers. These are individuals who need credit the most but are deemed highest risk. Faced with reduced profitability on these accounts, lenders could simply tighten their criteria, making it harder for millions to access credit cards. It could potentially push them into even riskier, unregulated lending markets, or severely limit their ability to manage everyday expenses or emergencies. It fundamentally alters the risk-reward calculus for financial institutions, impacting their lending practices and overall profitability, creating ripples through the entire consumer credit ecosystem. These actions, both global and domestic, whether framed as national benefit or political maneuvering, collectively feed into a palpable sense of unease. This isn't just anecdotal worry. It's quantitatively reflected in key economic indicators. The Economic Policy Uncertainty Index, a sophisticated gauge that tracks policy-related economic uncertainty by analyzing newspaper coverage, tax code expirations, and forecaster disagreement, has surged dramatically. This isn't a minor uptick. It indicates extreme market apprehension. When this index spikes, it signals that businesses become hesitant to invest, consumers delay major purchases, and markets struggle to price in future risks. This leads to a paralysis that can stifle growth and exacerbate volatility. It's the economic equivalent of driving through a dense fog. You slow down, you become cautious, and you delay any unnecessary maneuvers because you simply cannot see what lies ahead. This pervasive uncertainty is now the dominant force shaping short-term market sentiment. The most immediate and tangible threat emanating from this strategy of intimidation and assertive posturing is the very real reignition of global tariff wars, a specter that haunts international trade. Donald Trump has explicitly warned of a 10% tariff on imports from 8 European nations, including Denmark, the United Kingdom, and France. This would be effective as early as February 1st. But it does not stop there. He has threatened an escalation to a staggering 25% by June 1st if his demands, particularly regarding the acquisition of Greenland, are not met. This isn't merely a political spat. It's a direct frontal challenge to the global economic order. It's a deliberate attempt to rewrite the rules of international trade through coercion. We have seen this playbook before, and its consequences are well documented. The Trump's own goal argument, widely cited by economists during previous administrations, vividly highlighted that such tariffs disproportionately impact U.S. consumers and importers, rather than genuinely punishing foreign producers. Here's how it works. Tariffs are essentially taxes on imported goods. When a 10% tariff is imposed on, say, French wine, it's not the French winemaker who directly pays that tax to the U.S. government. Instead, it's the American importer, the distributor, or the retailer who pays it upon the wine entering the U.S. Who ultimately bears that cost? An estimated 96% of the costs are passed directly onto American consumers through higher prices, or absorbed by American businesses through reduced profit margins. Imagine going to the grocery store and suddenly everything you buy from overseas costs more. That's the practical effect. Rather than creating a level playing field, these tariffs act like a tax on American households and businesses. They reduce their purchasing power and competitiveness, effectively scoring an economic own goal. Europe's response to these threats is hardening by the day. It is a clear signal that they are prepared to defend their economic interests. And Europe holds significant leverage. European nations collectively hold over $8 trillion in U.S. bonds and equities. This is an immense financial stake that gives them powerful retaliatory options. They are now openly discussing a range of punitive measures. One particularly potent threat is the strategic sale of U.S. treasuries. If Europe were to collectively offload a significant portion of its U.S. bond holdings, it would flood the market with U.S. government debt. This surge in supply would inevitably drive down the price of treasuries and, critically, send U.S. interest rates soaring. Higher interest rates would mean dramatically increased borrowing costs for the U.S. government itself, exacerbating its national debt burden. It would also translate into higher mortgage rates for American homeowners, more expensive car loans, and increased capital costs for U.S. businesses, stifling investment and economic growth. This is an economic weapon that could inflict substantial pain across the entire U.S. financial landscape, impacting the very flow of capital in the American economy. Beyond targeting the U.S. government's borrowing power, Europe is also contemplating targeted tariffs or stringent regulatory pressure on U.S. big tech giants. Companies like Apple, Alphabet, Amazon, Tesla, and Microsoft derive substantial portions of their revenue from the European market. These are crown jewels of the American economy, and their European operations are a critical revenue source. Europe could impose new digital services taxes, enforce stricter data privacy regulations, or apply targeted tariffs on their products and services. This could potentially slash their substantial European revenues by anywhere from 15 to 30%. Such a move would directly hit the bottom lines of these highly valued companies, triggering significant declines in their stock prices. It would also impair their ability to invest in research, development, and expansion. This isn't just about trade goods, it's about disrupting the foundational profit centers of America's most innovative and influential corporations. The implications for investor confidence and the overall market valuation of the Magnificent Seven could be profound, potentially creating a dual-front economic assault on the U.S. economy. Yet, even as this political theater plays out on the global stage, dominating headlines and driving short-term market volatility, deeper underlying megatrends continue to shape the long-term economic landscape of 2026 and beyond. The most significant of these is the insatiable demand for artificial intelligence. This is creating not just an unprecedented boom in data center construction, but critically, a looming power crisis that demands innovative solutions. Why insatiable demand? Because AI models are hungry beasts, consuming vast amounts of computational power to learn, process data, and execute complex tasks. Training just one large language model can require as much electricity as thousands of homes. As AI permeates every sector of the economy, from healthcare to finance to manufacturing, the number and size of data centers needed to house the necessary infrastructure are exploding. This rapid expansion, however, is creating a massive strain on existing electrical grids. The power demands are so immense that many regions are struggling to provide sufficient, reliable, and sustainable energy. This is leading to what can only be described as a looming power crisis, a silent but profound challenge to the AI gold rush. Domestically, in response to this unprecedented energy appetite, a proposed data center power auction is gaining traction. The idea is to incentivize the construction of new power plants specifically designed to meet the growing needs of AI. Through long-term contracts, often spanning decades, the government or private consortiums would guarantee revenue for these new power generation facilities, making them highly attractive investments. This creates clear beneficiaries. Equipment suppliers, for example, companies like GE Vernova, which specialize in advanced turbines, generators, and grid solutions, are poised to benefit immensely from this wave of infrastructure spending. Their order books are likely to swell as utilities and independent power producers race to bring new capacity online. However, this aggressive push for new power infrastructure also presents significant challenges and even threats to established utilities. Companies like Constellation Energy, which operate vast existing nuclear, hydro, and fossil fuel power plants, could face headwinds. The risk is twofold: potential oversupply in the long run if too many new plants come online too quickly, leading to downward pressure on electricity prices. The other risk is the imposition of price caps by regulators seeking to protect consumers from potentially higher costs associated with these new, dedicated AI power sources. This could erode the profit margins of traditional utilities and force them to rethink their long-term investment strategies, creating a disruptive force within the energy sector itself. The strategic imperative to secure energy for AI is leading to fascinating corporate maneuvers. Consider Google's strategic move to acquire an energy infrastructure firm like Intersect. This highlights a critical shift towards vertical integration in the AI power race. By literally buying and building its own power supply, Google isn't just a tech company anymore, it's becoming an energy company. Why? Because controlling its own power supply grants Google unparalleled advantages: speed in deploying new data centers without waiting for overburdened utilities, flexibility to design power solutions perfectly tailored to its unique AI computational needs, and significant cost advantages in the long run by bypassing fluctuating energy markets and utility markups. Google is exploring everything from massive investments in renewables like solar and wind farms to the cutting-edge potential of small modular reactors, or SMRs. These are essentially smaller, safer, and more rapidly deployable nuclear power plants. It is even venturing into the more futuristic realm of space-based energy solutions. Concurrently, Elon Musk's Tesla is showcasing its own unique approach to rapid energy deployment. The company is actively deploying Megapack-powered data centers, emphasizing speed as a key differentiator. Tesla's Megapacks are massive, modular battery storage systems that can be rapidly assembled and deployed, providing instant, scalable power solutions. This focus on speed isn't just about efficiency. It's about competitive advantage in the AI arms race. The ability to bring new computational capacity online faster means quicker iteration of AI models, faster development cycles, and a distinct edge in a market where first-mover advantage can be everything. This intense competition for AI dominance extends beyond infrastructure and into the human capital realm, fueling an unprecedented AI talent war. Companies like Google are reportedly offering multi-million-dollar do-nothing contracts to top AI engineers. These are essentially paying them exorbitant sums simply to prevent them from working for competitors. It's a testament to the scarcity and immense value of elite AI talent. Meanwhile, the very nature of software development is undergoing a paradigm shift. New AI coding paradigms, such as vibe coding, where AI actively assists in generating and refining code, are threatening traditional software development roles by automating significant portions of the coding process. This dynamic is propelling firms like Anthropic, with its Claude AI models, to the forefront of the API market, providing access to powerful AI capabilities that are becoming essential for businesses. In fact, Anthropic has recently surpassed OpenAI in certain market share metrics, illustrating the rapidly shifting competitive landscape within the AI development sector itself. Amidst this swirling vortex of political uncertainty and geopolitical brinkmanship, we are beginning to observe a clear and compelling market rotation. This is a strategic repositioning of capital in anticipation of what may come. Small cap stocks, often overlooked in the shadow of the Magnificent Seven, are now showing distinct signs of outperformance. Historically, these smaller companies have been significantly undervalued compared to the broader S500. The S currently trades at a lofty 38 to 40 times 10-year average earnings, a valuation reminiscent of the dot-com bubble levels that preceded significant market corrections. However, analysts are now projecting small caps to significantly outpace large caps in earnings per share growth through the second quarter of 2026. This anticipated surge is not random. It's driven by their heavy involvement in the physical infrastructure and specialized hardware crucial for the foundational build-out of artificial intelligence capabilities. These are the companies laying the pipes, manufacturing the components, and providing the services that literally make the AI revolution possible. They often operate below the radar of the everyday investor, but are poised for substantial growth if this infrastructure boom continues. Simultaneously, the flight to safety, a classic market response to heightened volatility, is becoming increasingly evident. Concerns over quantum computing's long-term threat to Bitcoin's cryptographic security are prompting some institutional investors, notably figures like Jefferies' Christopher Wood, to strategically pivot from cryptocurrencies to physical gold. This isn't just an isolated anecdote. It signals a broader shift towards tangible, traditional assets that have historically held their value during times of geopolitical and economic upheaval. While Bitcoin has captured headlines for its meteoric rises, its digital nature and theoretical vulnerability to future quantum decryption capabilities are now prompting a reassessment of its role as a true safe haven. Gold, with its millennia-old track record as a store of wealth, offers a sense of enduring security that digital assets, for all their innovation, are still struggling to fully replicate in the minds of some cautious institutional players. Despite the looming threat of European tariffs and the broader geopolitical headwinds, the Magnificent Seven and other big tech players possess immense financial resilience. Microsoft alone, for instance, holds over $100 billion in cash reserves. This staggering war chest provides a critical buffer against potential revenue losses from tariffs or regulatory pressure. It also fuels their continued dominance in the artificial intelligence arms race. This allows them to make strategic acquisitions, invest heavily in research and development, and withstand market shocks that could cripple smaller firms. While European tariffs could indeed slash some of their substantial European revenues by 15 to 30%, these giants have the capital firepower to absorb such hits, pivot strategies, and continue their relentless pursuit of AI leadership, making them resilient contenders in the long run. Their financial strength could allow them to outlast competitors and potentially acquire distressed assets. Our core message, therefore, remains steadfast amidst the noise. 2026 is fundamentally projected to deliver historic earnings per share growth across the S500. This foundational strength, driven by corporate innovation and the AI revolution, suggests that deep, sustained market downturns are less likely, even with the heightened political noise emanating from Washington. Therefore, resisting the urge to sell out of high-quality U.S. assets, especially those with strong fundamentals and exposure to long-term growth trends, remains crucial. While short-term volatility is unavoidable and emotionally taxing, the underlying economic engine of the United States remains robust. Long-term holding in the U.S. market has historically proven to be a winning strategy. It has generated average annual returns of 10 to 12% over extended periods, consistently outpacing other asset classes. Attempting to time volatile political cycles, jumping in and out of the market based on daily headlines or political pronouncements, is often a losing proposition for most investors. It's a strategy fraught with risk, often leading to missed rallies and amplified losses. Instead, patience and conviction in fundamentally strong companies are your greatest allies. Investors who remain disciplined and benefit from underlying growth tend to fare better than those who panic sell during political uncertainty and miss the eventual recovery. For those looking to strategically navigate this environment, investors often consider identifying opportunities in companies directly benefiting from the AI infrastructure boom. This includes firms involved in energy integration, like Google's strategic moves into power acquisition, or companies like Bloom Energy in distributed power generation. Specialized AI software providers, such as Palantir, with its sticky, enterprise-grade data platforms, can also be compelling. Furthermore, robust hardware manufacturers like Samsung in advanced chips or First Solar in renewable energy infrastructure, which may be unfairly punished by short-term headlines but have strong underlying demand, can present attractive entry points. These are the companies building the future, and their long-term prospects may outweigh temporary political headwinds. Looking immediately ahead, this week is packed with market-moving events that will test investor sentiment and provide further clarity. Tonight, after market close, we anticipate the earnings report from Netflix. This could set the tone for the broader technology sector and offer insights into consumer spending trends. Thursday brings crucial economic data, the October and November PCE inflation reports. These will provide vital insights into the Federal Reserve's future rate decisions and its fight against inflation. We will also see the Michigan Consumer Sentiment Index, a key gauge of consumer confidence and spending intentions. Also, keep a close eye on Federal Reserve Governor Lisa Cook's comments for any hints regarding monetary policy shifts. We also await the Bank of Japan's rate decision, which could ripple through global currency markets. But the most anticipated event, undoubtedly, remains the unfolding drama around President Donald Trump's tariff threats and Europe's potential counteractions. The outcome of these negotiations and pronouncements, potentially unfolding at the prestigious Davos Forum this week, will heavily influence market sentiment and global trade flows in the short term. Any de-escalation could provide a bullish catalyst, while further hardening of positions could send another shockwave through markets. Here, diplomatic resolution represents a better outcome than a full-blown trade war. To recap, 2026 has begun with a complex intertwining of geopolitical friction, driven by President Donald Trump's aggressive policies and rhetoric. This is combined with a rapidly evolving artificial intelligence landscape, creating unprecedented demand and innovation. The global market is desperately trying to price in these new realities, swinging between fear and opportunity. While the political headwinds create undeniable volatility and uncertainty, the foundational strength of corporate earnings and the long-term structural growth in artificial intelligence and critical infrastructure remain compelling and should not be overshadowed. These are the powerful undercurrents that will ultimately shape the economic trajectory for the coming decade, regardless of the political headlines. The key takeaway for savvy investors is clear: filter out the noise. Focus on the underlying fundamentals of company strength and long-term growth drivers. Maintain a disciplined, long-term perspective. Opportunity often arises from strategic shifts and market dislocations, and 2026 will be no exception. Staying informed, staying invested, and staying ahead of the curve is crucial. Your ability to distinguish between temporary political theater and enduring economic transformation will be your greatest asset.